Welcome to the data dawning, where the data speaks. We listen. It's time to unlock the numbers and decode the story. Welcome, everyone, to this deep dive. We've got a whole stack of sources in front of us, expert analysis reports, charts, you name it, and we're going to unpack what the data is really telling us right now. Our mission today, essentially, is to cut through all that noise. We want to get to the core insights on the macroeconomy, specific market moves, some key technicals, the latest on trade, and also what's happening in alternative assets like crypto.
And, as always with these complex topics, the data gives us more of a mosaic, right? Not just one single clear picture. You get different experts looking at the same landscape, highlighting different points. And, well, sometimes they arrive at pretty varied conclusions. So our job here is to kind of guide you through that. Look at these perspectives impartially so you can really understand the key takeaways and maybe some of the conflicting signals from all the source material you've shared.
Absolutely. It's about trying to see that full picture, even when, the pieces don't seem to fit perfectly together right away.
Okay, so let's unpack this first big idea that seems to be popping up. A lot of our sources, especially the ones looking at the big economic picture, they're pointing to something fundamental changing under our feet. It feels like more than just a typical cycle. They're suggesting we might be in a completely different economic environment than, say, just before the pandemic, like a shift to a whole new regime.
Yeah, that concept, the new regime, it's a really powerful theme running through a lot of this material. Darius Dale over at 42 Macro, he's a strong voice on this. He argues pretty compellingly, actually, that the economic era we were in, roughly, 2010 to 2020, that effectively ended when COVID hit back in 2020.
Right. And what was it about that 2010 to 2020 period that makes it look so distinct now looking back? Well, that decade, it was marked by some truly extraordinary conditions. You had persistently low inflation, often below 2%. You had near zero, sometimes even negative interest rates from central banks. And of course, massive, sustained quantitative easing, which is basically, central banks creating new money electronically to buy assets, the whole money printing idea.
Ah, yes, the money printing era. And the sources are saying this wasn't just unusual, but like historically unique.
That's exactly the argument Jim Bianco makes, and he brings in some deep historical context. He references this classic economics book, A History of Interest Rates. It tracks interest rate data meticulously, going back 5,000 years, think 3000 BC. And Bianco's point is really striking. In that entire huge span of history, thousands of years of economic activity, there's basically zero mention of negative interest rates on any broad scale.
Yep.
Maybe some tiny sporadic instances of zero rates, but that's it. He calls that 2010-2020 period a unique experiment in human history that we did one time in 5,000 years.
Wow. Okay, thinking about it in terms of 5,000 years definitely puts it in perspective. So the core idea from these sources is that this unique experiment, it's just over now, unequivocally.
Yes, both Dale and Bianco are pretty emphatic about that. The 2010-2020 regime, it's behind us. And maybe more importantly, they suggest it's really unlikely we'll go back to those specific conditions anytime soon. Bianco, maybe with a touch of hyperbole just to make the point, even suggests, maybe not for another 5,000 years, the forces, the policies that created that low inflation, zero rate world, they just aren't the main drivers today.
Okay, so if the old playbook is gone, what are the defining characteristics of this new regime we've apparently entered? What does it actually feel like?
The sources seem to converge on two key things: stickier inflation and higher interest rates.
Stickier inflation, meaning inflation is probably going to hang around at higher levels than we got used to, not just a blip.
Exactly. Bianco argues we kind of need to reset our mental baseline for inflation. Instead of thinking about sub 2%, maybe we should be thinking about inflation settling somewhere in the 3% to 4% range. That's a fundamental shift from the target and the reality of the last decade. I mean, even recent data points like the figures Yahoo Finance discussed being at a 4-year low, well, they're still significantly higher than anything we saw consistently between 2010 and 2020. And that higher floor for inflation, it naturally implies a higher floor for interest rates, too.
And how else is this new regime showing up beyond just the headline inflation numbers? Are there structural shifts happening that are driving this?
Yeah, sources point to some really fundamental changes that happened around 2020 and are still playing out. One huge structural shift they highlight is the massive increase in remote work. Before COVID, something like only 6% of the U.S. workforce primarily worked remotely. Now, that number shot up to around 25% today. And remote work here means, getting paid to do your job away from a central office.
That's a huge, rapid change in how people work.
It really is. And another big structural change mentioned is what Jim Bianco calls the end of hyperglobalization and a shift towards segmentation.
Segmentation. What does that mean in practice?
It's basically a move away from those super intricate, globally optimized supply chains that were all about cost efficiency above everything else. Instead, what we're seeing is a trend towards more regional production, maybe shorter supply lines, a bigger focus on resilience and security, not just pure cost. This trend, plus things like tariffs and trade barriers, it just introduces more friction into the economy, makes it harder for prices to fall quickly, and that contributes to that stickier inflation we talked about. These aren't just temporary things, they're reshaping global trade and labor structures.
Okay, here's where it gets really interesting and where the sources maybe show a bit of a disconnect. Both Bianco and Dale seem to highlight a potential gap between what a lot of the market narrative is focused on, especially this anticipation of quick Fed rate cuts, and what the actual hard economic data is showing. Or, crucially, what the Fed itself, under Powell, seems to be focused on.
Yeah, that disconnect is a key insight, I think. You hear so much market commentary predicting, imminent Fed pivots based on maybe some wobbles in soft data, things like sentiment surveys, business expectations. But the argument from these sources is that this might be misreading the situation in this new regime. Yeah. They suggest the Fed's main focus, as Powell communicates it, is on concrete, sustained data points, prices, inflation, and the labor market, actual jobs.
So the whole Fed pivot narrative, the idea that cuts are right around the corner, that might be based on the old 2010-2020 playbook, where any hint of weakness meant instant stimulus.
But that's exactly the critique coming from Bianco and Dale. They argue that focusing on soft data as a leading indicator for Fed cuts is probably flawed in this environment. Bianco uses the recent JOLTS report, the Job Openings and Labor Turnover Survey, as a perfect example. In April, job openings actually increased quite a bit, from 7.1 million to 7.39 million. That data point directly contradicted the narrative going around at the time that soft data was collapsing, signaling a recession was coming, and that would force the Fed to cut.
So the hard data, jobs and inflation, that leads, and the sentiment stuff follows.
That's the interpretation presented, yeah. Soft data like surveys often tends to be a lagging indicator. It reflects how people feel about the current economic reality, rather than predicting future turns or Fed policy shifts. Bianco argues Powell's message is pretty clear. He sort of paraphrases it as, "Call me when the labor market is bad, not when it might be bad." He emphasizes the Fed is looking for consistent, undeniable proof of a weakening labor market, number after number and anecdote after anecdote, before they'd consider big policy shifts like rate cuts. Until then, the focus stays on getting inflation down definitively and sustainably.
That really challenges the market's apparent eagerness to price in multiple rate cuts so quickly.
It absolutely does. Now, the market itself, if you look at Fed fund futures, it already prices in a fairly low chance of cuts in the very near term, less than 50% for June and July, only about 55% for September, based on when the sources were created. But the deeper point from Bianco and Dale is that the fundamental expectation for a return to that low-inflation, zero-rate world might be misplaced in this new environment. For the Fed to cut rates significantly, inflation wouldn't just need to dip, it would need to stay low, convincingly heading back towards that sub-2% target for a sustained period. And they see that as a pretty long shot in this new structural regime.
And hey, if you're finding value in us unpacking all this complex data, maybe drop a like and share this deep dive. It helps others find it too.
Okay, so if we accept this idea, this premise that we're in a new regime, stickier inflation, higher rates is the baseline, what does that mean specifically for interest rates? Especially those longer-term Treasury yields, the ones that influence everything from mortgages to company borrowing costs. Well, Jim Bianco offers a perspective here that directly challenges the common market narrative. The idea that current yields, like the roughly 4.5% we've seen recently on the 10-year Treasury, are unusually high or somehow problematic.
Right. You hear a lot of hand-wringing about the 10-year being at these levels, people suggesting it's a sign of economic strain or risk.
That's the common view, and it's kind of rooted in the expectations built up during that previous low-rate era. But Bianco argues that in an environment where inflation is likely to hover between 3% and 4%, maybe a 5% yield on the 30-year bond is actually exactly where it should be. He calls it normal. And this is a really fascinating contrast to a perspective noted in the Yahoo Finance sources, where Treasury Secretary Scott Bessent was reported as seeing anything above 4.5% on the 10-year as being in a danger zone.
Wow, okay, so one expert sees 5% on the 30-year as normal, while the Treasury Secretary flags 4.5% on the 10-year as dangerous. That's a pretty significant disagreement on what normal or safe even means in this market.
It really highlights how expectations are still adjusting, Bianco's point is that maybe the discomfort with current yields comes from being anchored to that historically abnormal 2010-2020 period. In the context of 3–4% expected inflation, a 5% long-term yield gives you a reasonable real return, and in his view, there's nothing wrong with that level.
But sometimes it just feels counterintuitive. Why do yields, especially the long-term ones, seem to rise even when the Fed tries to sound dovish or hints at cuts? You'd think the opposite should happen.
This is where Bianco offers a really powerful interpretation of how the market's behaving. He basically views the bond market's reaction in those moments as a direct rejection of the Fed's dovish signals. And he gives some pretty compelling examples from the sources. Remember when the Fed cut rates by 100 basis points total through 3 separate moves last year, September, November, December? What happened to the 10-year yield? It actually went up 1.2% over those 4 months. Similarly, yields climbed significantly after the Fed paused its hiking cycle back in July 2023.
So the bond market isn't just passively reacting, it's actively pushing back, like saying, nope, not buying it.
Precisely. Bianco interprets this as the bond market, essentially saying, hey, Fed, you are not being vigilant enough about inflation right now. By signaling cuts or pausing hikes while inflation is still sticky, you're not doing enough. So, to compensate for what they see as a lack of Fed vigilance, bondholders demand higher yields. He calls this the bond market vigilantes being active again, pushing long-term rates higher when they think the Fed is too hesitant on inflation or too eager to cut prematurely.
This implies that betting on a big drop in long-term yields might be a really tough trade in this kind of environment.
That's definitely the conclusion drawn from that perspective. Bianco suggests this dynamic means there's very, very little upside to owning long bonds if your whole investment idea relies on yields falling a lot. Conversely, he says, there are endless reasons for long bond yields to surge higher if inflation stays sticky, if the market keeps feeling the Fed isn't aggressive enough, or, if fiscal issues come more into focus.
Speaking of fiscal issues, what about the huge amount of U.S. government debt and the ongoing deficits? Doesn't that massive supply of bonds just have to push rates higher?
Bianco agrees, yeah, the sheer size of the deficits is a significant problem, no question. But he makes a distinction between the deficit as this long-term structural challenge and its immediate impact on why the 10-year yield is at 4.5% today. He argues that the bond market will always find the money to fund the U.S. government's borrowing needs.
Always. How does that work?
Well, his argument is the mechanism is pretty simple, though potentially painful for other markets. The Treasury will just keep raising the interest rate they offer on bonds until enough buyers step up. He uses some pretty memorable language to describe it. They'll suck money out of every other investment, or if they have to, they'll suck the life out of the stock market. So the immediate problem, in his view, isn't that the current 5% yield on the 30-year is too high. It's the possibility that a much higher yield might be required down the road to attract buyers for the ever-growing mountain of debt.
Wow, sucking the life out of other markets. That's a potent image. Maybe a good time to remind folks subscribe to the Snippet Labs YouTube channel to keep getting deep dives like this.
Right. That potential future need for significantly higher rates, that's the core long-term risk the sources highlight when talking about the deficit.
Okay, so let's put this together. We've got sticky inflation, potentially higher baseline interest rates enforced by these bond market vigilantes, huge deficits looming, and current stock valuations that some people think are pretty high. What's the big picture for stock investors then?
Bianco lays out his 4-5-6 markets framework as a way to think about expected returns over the next few years in this kind of new regime. Based on current conditions and valuations, cash equivalents like T-bills or money market funds, maybe they offer expected returns around 4%. Bonds, thinking maybe intermediate duration, could offer expected returns around 5%. And stocks, represented by a broad index like the S&P 500, might offer expected returns somewhere around 6%.
Okay, 4%, 5%, 6%. I mean, that sounds dramatically less exciting than the 15–20% annual gains a lot of investors got used to in recent years.
It's a significant dial back in expectations, absolutely. And that's precisely the point. Bianco stresses that investors really need to adjust their outlook based on this new reality. A 6% expected return for stocks isn't necessarily him being bearish. It's just a fundamentally different environment than one where stocks felt like the only game in town offering real returns.
And this higher rate environment, it makes cash and bonds much more competitive alternatives compared to stocks, doesn't it?
Absolutely. When cash and bonds are offering attractive yields, yields that might actually beat inflation, they become really viable alternatives, especially when stock valuations are already looking stretched. This totally dismantles that old TINA acronym, there is no alternative. that people use so much in the low-rate world to justify high stock prices
Mm.
because cash and bonds paid basically nothing. Well, now there are alternatives.
You mentioned high stock valuations. How exactly do the sources characterize where we are now?
Bianco points to the S&P 500's forward price to earnings, or PE ratio, being around 22. The PE ratio, just quickly, shows how much investors are willing to pay for each dollar of a company's expected future earnings. So a PE of 22 means investors are paying $22 for every dollar of expected earnings over the next year. Now, it's not dot-com bubble crazy, but 22 is considered pretty high historically. Bianco argues that at this level, the market is basically fully valued. It needs almost everything to go right for it to keep pushing significantly higher from here.
And this valuation picture looks quite different globally, right? The U.S. versus other markets.
Yeah, he contrasts the expensive U.S. market, that PE, around 22, with markets in Europe, which he notes are trading at a much lower PE ratio, somewhere around 12. He suggests that maybe some of the recent market rotations we've seen might just be a logical flow of capital, money moving from relatively expensive assets in the U.S. to relatively cheaper assets elsewhere, especially when there's uncertainty around. He kind of pushes back against interpreting this purely as some grand sign of the end of American exceptionalism, a term he thinks is often misused and politically charged. He argues the valuation difference itself is a simpler, more direct explanation for some of these flows.
What about that idea we hear thrown around a lot, the trillions of dollars in cash on the sidelines, just waiting to pour into the market and send stocks soaring?
Ah,
Yeah.
yes. Jim Bianco, with his 40 years in the market, he's pretty blunt about that narrative. He calls it a nice narrative, but then says quite plainly, it doesn't work that way. It's never worked that way.
Never. That
Yeah.
feels like almost market gospel sometimes.
He really challenges that idea. The $7 trillion or so that gets cited in money market funds.
Hmm.
His view, based on looking at who actually holds these funds, is that a huge chunk isn't speculative money itching to jump into Tesla or Bitcoin. He thinks much of it is held by older, more conservative investors who are actually perfectly happy earning 4% plus yield that's currently beating inflation. For them, it's about capital preservation, stability, letting them sleep at night, not chasing risky returns. They're probably not going to suddenly dump all that into stocks.
Okay, let's shift gears a bit now and look at what the charts, the technical indicators, are telling us about the market's current health. Because even with all these macro questions and valuation concerns, the major indices are trading near all-time highs.
Mhm.
But are there conflicting signals maybe hiding beneath the surface?
Oh, absolutely. The technical analysts featured in the sources, people like Bob Lane and Michelle Schneider on Yahoo Finance, they definitely highlight this kind of divergence. The S&P 500, yeah, it's hovering close to its record high, maybe 100 points shy of that 6144 level discussed. So visually, the headlines look strong.
But the technical picture isn't uniformly bullish across the board.
Correct. Bob Lane notes the market is currently in an overbought condition. That's a common technical state, where prices have run up really fast without any significant pullbacks. But, and this is crucial, he makes a key distinction. Overbought is a condition, not an immediate sell signal.
Okay, what's the difference there? Condition versus signal in technical terms.
Well, a condition, like being overbought, it just describes the market's current momentum state. It's run up hard. And that condition can actually stick around for a lot longer than people often expect. A signal, on the other hand, that's a specific price action, or maybe a pattern that suggests a potential reversal or change in trend might be imminent, like maybe a break of a key support level or a specific bearish chart pattern forming. So Lane suggests that while the market is overbought, it's more time for caution. Maybe take a little pause, perhaps raise your cash level slightly, do some house cleaning in your portfolio, but you wait for a clear signal, like maybe a pullback of 1-3%, before making big tactical moves like selling short or deploying a lot of cash to buy. The overbought state itself doesn't guarantee a drop is coming right now. Michelle Schneider, she really zeroes in on what she calls the inside sectors, think retail, transportation, and small caps. She sees them as vital gauges of the market's underlying breadth and maybe the health of the real economy.
And what are these inside sectors telling us at the moment?
Well, according to her, they are significantly lagging behind the performance of the big indices and those leading growth stocks.
How far behind are we talking?
Schneider points out that the retail sector, for example, is still almost 30% below the peak it hit way back in 2021. Transportation stocks and small caps, often tracked by ETFs like IWM, they're trading below their key 50-week moving averages. That usually indicates a bearish or consolidating trend from a longer-term weekly chart perspective. And this contrasts really starkly with the technical picture for the leading areas, like growth stocks and especially semiconductors, tracked by the SMH ETF. Vincent Desiano, another analyst in the sources, he actually describes the SMH chart as looking peaceful and clean. It's trading strongly above its key weekly moving averages. The 50-week is comfortably above the 200-week that signals a really powerful bullish trend. He contrasts that with the charts for the broader NASDAQ or S&P 500 futures, NQS, which he calls dirty and choppy, full of wicks, those thin lines on candles showing price extremes that got quickly rejected in what he calls manipulation liquidity grabs, implying kind of erratic price moves designed to trap traders.
So, the technical strength seems really concentrated in just a few key areas, mainly big tech and semiconductors, while the sectors more tied to broader consumer activity and goods movement look weaker.
That's Schneider's core argument, yeah. She contends that you really need participation, strong performance from these inside sectors, retail, showing how consumers are spending, transportation showing goods moving, small caps as a pulse of the domestic economy. You need that to validate a truly healthy, broad-based rally. Their current lagging performance suggests the market's advance is narrow, driven by just a few dominant names and sectors rather than reflecting widespread economic strength.
What about drilling down into the big tech names themselves, the MG7? Apple seems to be standing out there.
Yes, the Yahoo Finance sources specifically highlight that Apple is currently the only stock among that traditionally dominant MAG7 group that's trading below its 50-day moving average. Given Apple's history as such a strong market leader, its relative technical weakness within that group is definitely notable. There's also some caution expressed in the sources about just continuing to pile into stocks like NVIDIA at their current really high valuations and strong momentum. Suggestions that maybe other parts of the market or even different assets entirely might offer better risk-reward opportunities from here.
Vincent Desiano also gave us some specific technical levels he was watching on the futures charts right after that latest CPI inflation data came out. That data seemed to cause a pretty noticeable market reaction, right?
It absolutely did. The CPI data was generally seen as positive by the market. It showed inflation slowing year over year and even a slight decrease month over month. That sparked an immediate pop higher in the markets. Desiano then outlined some key price levels he thought were critical to watch, either for validation that the upward move could continue or as signs it might fail.
Okay, what were those crucial levels he was watching from a technical standpoint?
Right, so on the NASDAQ Q futures, NQ, he stressed that the 22,000 level was an absolute must-hold support. If NQ broke below 22,000, he expected a pretty significant move down. Above that, key resistance and target levels were 2120, then 2200, and 2300. He noted that getting above 2120 was kind of a key area, representing potential freedom for more upside. For the S&P 500 futures, yes, the critical support to hold was 6050. The immediate target of 6 to 75 got hit really quickly after the CPI news, with the next target up being 6113. For the QQQ ETF, which tracks the NASDAQ Q100, the important support level to hold was 535. If that failed, he expected the price to come right back down. Key resistance was near the all-time high at 537, and the next upside target was that all-time high itself, around 540. And finally, for the SPY ETF, tracking the S&P 500, the must-hold zone was 603-604. The initial target of 607 was reached, with the next target above being 610. Desiano consistently emphasized how important it was for these support levels to hold, especially that 22,000 on the NASDAQ Q, as validation that the momentum had truly shifted post-CPI and could keep going. He also repeated his trading preference.
He likes pullback longs. That means waiting for the price to retrace back down to a support level before buying, rather than chasing a rapid move higher, especially on a day where the market gaps up strongly.
Got it. So it really sounds like the technical picture is marked by this ongoing tension. You've got strong momentum and leadership pushing the headline indices up to highs, but there's caution warranted because the rally seems narrow and these key underlying sectors are lagging behind. Let's shift our focus now over to the latest on U.S.-China trade policy, because the sources we looked at here present a somewhat complex and, sometimes contradictory picture of where things actually stand.
They certainly do. Those recent trade talks held in London, they seem to have yielded pretty different interpretations depending on which source you read.
Okay, what was the more optimistic take coming out of those London talks?
Well, Yahoo Finance reported on a narrative suggesting the relationship between the U.S. and China seemed to have stabilized somewhat. The report mentioned an agreement to restart rare earth mineral exports from China and ongoing talks about addressing U.S. export controls on semiconductors, both key friction points. Treasury Secretary Scott Bessent, in his testimony, reportedly cautioned China to right-size its economy, basically, shift focus more towards domestic consumption, less heavy reliance on production and exports. But he also apparently expressed some optimism that a big, beautiful rebalancing of the trade relationship is possible if China sticks to commitments made in a previous initial agreement in Geneva.
And President Trump chimed in on this too, right?
Yes, President Trump made a statement on Truth Social talking about a hypothetical trade scenario involving 55% tariffs for the U.S. versus 10% for China.
Okay, so that's one narrative, stabilization, potential rebalancing. What was the counter narrative presented in the sources? The more skeptical view.
Darius Dale from 42 Macro offered a significantly more skeptical take on those London talks and the whole U.S.-China dynamic. He stated pretty bluntly that the talks resulted in no breakthrough. Furthermore, he argued that China continues to, in his words, run circles around the U.S. in negotiations. His perspective is that China often gets concessions from the U.S. just by agreeing to hold talks, potentially benefits from delays, and then demands more concessions later, even when there are perceived violations of previous agreements.
And he suggested the U.S., specifically the Trump administration, might be facing some constraints on how aggressive they can actually be with China.
Yes, Dale put forward the idea that the Trump administration might be somewhat constrained in its ability to really push for strategic decoupling from China. He links this to their fiscal policy goals, suggesting they maybe can't afford a rapid, full economic separation if their aim is also to outrun the financial consequences of bipartisan fiscal spending and deficits. It implies a potential tension between their trade strategy and domestic fiscal realities.
Right. And there was also some important clarification offered about those tariff numbers that were mentioned.
That's right. Ben Marskell, also featured on Yahoo Finance, gave some important context for that 55% tariff figure President Trump mentioned. He clarified it wasn't a proposal for new tariff rates coming out of London. Instead, it was a calculation based on averaging existing tariffs already in place. That includes tariffs on things like illegal drugs, fentanyl, around 20%, reciprocal tariffs implemented previously, around 10%, and those sector-specific Section 301 or most favored nation tariffs, which average about 25% on certain goods. According to Yale data mentioned, the overall effective blanket tariff rate on China, based on all these existing measures, averages out to about 33%. The London talks, reports suggested, were more focused on technical details like rare earths and semiconductors, not a big change to these average rates.
Okay, so we've got these clearly distinct narratives. One suggesting stabilization and a path forward, another arguing basically no real progress, and China still holding negotiating leverage. What about the impact of these tariffs existing or potential on the U.S. economy, particularly on inflation?
This is another area where the sources reveal differing views, and as one Yahoo source nicely put it, really highlights the squishy part of the whole situation.
The squishy part, what does that mean?
It refers to the inherent uncertainty about when and how the economic impacts of tariffs actually filter through into the official data, especially inflation numbers. Treasury Secretary Besson and a Yahoo Finance analyst noted that the most recent inflation data, the CPI and PPI reports, didn't yet seem to show the impact of existing tariffs. That observation seemed to defy some economists' warnings that tariffs, by raising import costs, would inevitably lead to higher consumer prices. However, other sources like Jim Bianco and Darius Dale suggested that tariffs could definitely still push inflation higher, or at the very least, prevent inflation from falling further towards the Fed's target.
So even the experts looking at the data aren't fully agreed on the timing or the size of the tariff impact on prices.
Exactly. This lack of clear, immediate data confirming those expected effects makes the situation squishy. It means policymakers, like the Fed, have to be cautious. They're likely waiting for more definitive data signals before making big policy decisions based purely on tariff impacts. The timing is just unclear, making it hard to fully assess the consequences right now.
Got it. There was also some discussion related to the administration's broader tax policy and potential implications for attracting foreign investment, right?
Yes. Treasury Secretary Besson reportedly spoke quite positively about the administration's big, beautiful tax bill, emphasizing benefits for American workers and families. He cited estimates suggesting pretty significant increases in take-home pay, like $7,800 to $13,300 for a family of four, and $6,100 to $11,600 for average workers. He also highlighted things like eliminating taxes on tips, Social Security, overtime, and noted a successful tax collection season with revenues up and waste cut at the IRS. However, John Hilsenrath, another analyst cited, pointed to a specific provision in that tax bill Section 899, which could potentially impose taxes on foreign investments coming from countries deemed to be using unfair trade practices. Hilsenrath noted this specific provision could frighten foreign investors.
And why is frightening foreign investors a concern, especially now?
Well, Hilsenrath suggested that Treasury Secretary Besson is actively trying to kind of avert the most severe effects of that provision. The worry is that raising the cost of capital for foreign investors wanting to put money into the U.S. would be detrimental. And that's particularly problematic given the U.S.'s huge borrowing needs. The government needs to borrow over $2 trillion a year, more than it takes in. Attracting that foreign capital is essential for funding this debt, so anything that makes the U.S. look like a less attractive place for global investment is potentially a big problem.
Makes sense. You should follow us on Twitter at Snippet Labs for more updates on these deep dives as well.
Right. So while the tax bill aims for domestic benefits, certain parts designed to tackle trade fairness could have these unintended consequences for the cost and availability of the capital needed to fund government borrowing.
Okay, moving beyond the traditional markets and trade policy now, let's turn our attention to the world of alternative assets and also the evolving landscape of financial technology, or fintech. Crypto's been getting a lot of buzz lately, especially with all the activity in those exchange-traded funds, the ETFs.
Yeah, Kristen Myers on Yahoo Finance specifically highlighted the really significant inflows seen recently into Ethereum ETFs. This marked a record seventh consecutive week of inflows for these Ether funds, totaling $326 million in just the most recent week covered. And notably, over $300 million of that went into just one fund, ETHA, the iShares Ethereum Trust.
Wow, that's a substantial amount of capital flowing into Ether specifically. What's driving that, according to the sources?
Myers suggested this reflects a very risk-on sentiment among investors right now. A potential catalyst she pointed to is the U.S. Securities and Exchange Commission, the SEC, appearing pretty favorable towards staking cryptocurrency. Staking, just quickly, is where holders lock up their crypto to help secure the network, and they can earn rewards, kind of like interest. So this perceived regulatory openness towards staking might be making Ethereum ETFs seem more attractive.
Is this just new money coming into the crypto space overall, or is it maybe shifting from other areas within crypto?
She noted that, yes, some of these inflows could represent money shifting away from the spot Bitcoin ETFs, which have been trading for longer, and moving into Ethereum ETFs as Ether itself gains more mainstream acceptance, becoming a sort of mainstream asset. However, she did caution that while inflows might continue as long as crypto prices are rising, the long-term role these assets play in a diversified portfolio, like, is Bitcoin really digital gold? That's still an open question, and she added a reminder that the ride for investors could still be a roller coaster, despite the recent positive momentum.
Okay, so strong inflows into Ethereum ETFs suggesting interest, maybe risk-on sentiment. What are the technical charts telling us about Bitcoin itself?
Vincent Desiano commented on Bitcoin's technical setup. He noted it was showing a nice little flagging move. That's a pattern technical analysts often watch, sometimes seen as a potential continuation pattern after a strong upward move. He noted Bitcoin was successfully holding above the 109,000 level. He's watching to see if this pattern resolves to the upside and expands further. He also suggested that continued strength in broader tech indices like the Nasdaq could potentially help Bitcoin if the overall market stays risk-on. He also specifically flagged MSTR, MicroStrategy, as a big watch. MicroStrategy, of course, is that software company that's become famous for holding a huge amount of Bitcoin on its balance sheet. Desiano found a technical setup on MSTR's weekly chart incredible. He pointed to what he saw as a clear major high that could potentially be transitioning into a phase setting up new lows based on a break and weekly chart retest. That's technical language describing a potential reversal pattern where a previous support level breaks, price tries to rally back to it from below, fails, and then potentially continues downward.
Interesting. But what kind of price movement was he thinking for MSTR if the market and Bitcoin actually stayed strong?
Right. Despite seeing that potential reversal pattern, Desiano also believed that if the overall market stayed risk-on and Bitcoin continued its positive trend, MSTR could actually see a significant move higher, potentially reaching the 440 area.
Oh.
So kind of setting up for a big move, potentially in either direction, depending on the broader context.
Jim Bianco offered a slightly different take on these highs in alternative assets, didn't he? Viewing both gold and Bitcoin hitting new highs as potential red flags. How do central bankers typically see these moves, according to him?
Yeah, according to Bianco, central bankers tend to view cryptocurrencies like Bitcoin, even when they hit big milestones, like 110,000, using a figure mentioned, mostly as a speculative vehicle. He suggests they might see the activities being driven more by retail speculation, maybe comparing it to things like the GameStop mania of 2021, fueled by what he called degens, basically, retail traders engaging in high-risk speculative bets. They don't necessarily interpret it as a fundamental loss of confidence in traditional financial systems like the US dollar. Similarly, he notes, central bankers often view gold, even with its own recent highs, as a very small market that isn't really representative of broader market sentiment or big concerns about the financial system's stability. However, Bianco argues that this perspective from central bankers is potentially risky. He thinks they should be taking it a little bit more seriously than that. He believes the reality for assets like Bitcoin and gold is probably kind of both at the same time, meaning, yeah, some of the buying is genuinely driven by investors looking for alternatives or hedges against inflation or systemic risks. But simultaneously, some of the activity is undoubtedly just pure speculative number go up behavior.
That duality is interesting. So these assets are hitting highs, but how they're interpreted by traditional financial authorities can be very different from how proponents see them. Maybe another reminder to follow us on Twitter at Snippet Labs for more updates and insights pulled from the data like this.
Exactly. It just highlights that ongoing debate about the real role and significance of these assets in the bigger financial picture.
Okay, let's wrap up this section by looking at the broader world of financial technology, fintech. Nigel Morris, who co-founded Capital One and is now deep in fintech venture capital, gave some interesting insights into the health and future of this sector.
Yeah, Morris asserts pretty strongly that fintech is alive and well. He's countering any narrative that the sector is somehow dying just because equity funding for startups pulled back from those crazy peak levels in 2021. He backs this up with data showing that fintech currently accounts for a relatively small slice, maybe only 3% of total global financial service revenue. But, and this is the key point, he notes that this small slice is growing much, much faster than the revenue of traditional incumbent financial institutions. Last year, fintech revenue grew by 21% compared to just 6% growth for the incumbents. He projects fintech's share of global financial revenue could grow significantly, maybe reaching 10% within the next decade.
And he mentioned a new generation of fintechs coming up. What makes them different? What areas are they going after?
This new generation, according to Morris, is really succeeding by dominating areas where traditional banks have historically been slow or just couldn't compete effectively. He lists examples like buy now, pay later, BNPL services, earned wage access, giving workers access to pay before payday, digital brokerage services, and cross-border payments for both consumers and small businesses. He argues these newer fintechs are building significant moats, competitive advantages in these specific market niches.
Why have the traditional banks struggled to keep up in these fast-growing areas?
Morris offers a really compelling explanation. He believes banks often mistake inertia with loyalty. Historically, it was just such a hassle to switch bank accounts, right? So customers often stayed put even if they weren't totally happy. This created a kind of false sense of loyalty. But he argues that emerging trends like open banking and increasingly sophisticated AI-powered financial agents are fundamentally changing that whole dynamic.
How do open banking and AI change the game?
Well, open banking lets customers securely share their financial data with third-party providers. That makes it much easier for new fintechs to understand your financial situation and offer really tailored services. And AI agents. Eventually, they could help you automatically find and switch to the best financial products out there, regardless of who provides them. Morris notes that younger generations, being digital natives, they just have different expectations. They're much more comfortable managing their finances across multiple apps and platforms. And this trend allows consumers to essentially fragment or modularize their banking relationships. Instead of getting everything bundled from one bank, you can cherry pick. You get the best high-yield savings account from one place, a great credit card from another, use a specialized fintech for international money transfers or BNPL. He suggests banks culturally are often designed to be defensive to avoid mistakes. That makes them less agile, often not great at creating the kind of unique, personalized products needed for this new modular world.
It sounds like fintechs are basically filling the gaps and catering to a whole new set of consumer expectations that traditional banks are finding hard to meet.
That's really the key takeaway. Morris sees fintechs as the main innovation platforms in finance right now. His strong message to the incumbent banks is clear. They need to actively engage with this ecosystem. They've got to adapt, partner, buy, or learn from the rapid innovation happening in fintech if they want to stay competitive long-term.
Absolutely fascinating stuff. And if you found this deep dive valuable, please consider dropping a like and sharing it. So, wow, we've covered a considerable amount of ground here, pulling insights from across this whole stack of sources. We started with that really compelling argument that we've fundamentally shifted into a new macro regime. We've left behind that low inflation, zero rate world of 2010, 2020, and we're now in an era of, well, stickier inflation and likely higher baseline interest rates.
Yeah, and we explored that fascinating dynamic of the bond market potentially acting as vigilantes, pushing back against perceived Fed dovishness and influencing long-term rates. We've talked about those differing views on whether current yields are normal or maybe a danger zone in this new context. And we consider what this environment, they got higher rates, current valuations means for expected returns across different asset classes, like Bianco's 456 framework, lower expectations, basically.
Then we dug into the market technicals, highlighting that tension between the headline indices hitting highs, but also the concerning lack of participation from those broader inside sectors. That creates conflicting signals for technical analysts trying to read the market's health. We also looked at the nuanced and sometimes contradictory narratives around U.S.-China trade policy, noting the uncertainty about when and how tariff impacts might actually show up in the inflation data, that squishy part.
And finally, we explored the world of alternative assets and fintech disruption, those significant inflows into Ethereum ETFs suggesting risk-on sentiment in crypto, the technical picture for Bitcoin and MicroStrategy being watched closely, and that perspective that traditional finance is really being challenged and reshaped by these nimble fintechs capturing market share and catering to the modular needs of digital native consumers.
It's just crystal clear from these sources that both the economy and the markets are navigating a really complex transition period right now. The old frameworks, the expectations developed during the last unique economic cycle, they're being seriously challenged by the realities of this new environment. There's this constant interplay and sometimes real tension between the economic data itself, the market narratives floating around, the technical signals on the charts, and the policy approaches being taken.
It really does feel like the established definition of normal in finance is being actively debated and rewritten in real time, doesn't it? As everyone tries to figure out the rules of this new regime, those extraordinary monetary policies of the past decade seem firmly in the rearview mirror now. And the market is adjusting, maybe unevenly, but definitely adjusting to a different baseline for rates and for asset valuations. Given our discussion about those significant U.S. government deficits, the observation that the bond market seems to require higher interest rates to find funding, and that note from some sources about a global trend towards countries issuing more short-term bills instead of long-term debt. Maybe here's a provocative thought for you to consider. If major sovereign borrowers, not just the U.S., are increasingly relying on short-term funding and shying away from issuing long-dated bonds, does that fundamentally alter the deep plumbing, the stability of the entire global financial system? What could be the unintended consequences of that shift down the line? Is that strategy even sustainable in the long run, or does it just kind of defer a larger funding challenge into the future, potentially setting the stage for a much more disruptive adjustment later on? Something to think about.
Definitely food for thought. Remember to subscribe to the Snippet Labs YouTube channel and follow us on Twitter at Snippet Labs for more updates. Markets move fast. Pinpoint your next profit window and seize the moment.